Created with free version for non-commercial use.
Okay, so welcome back to the trading desk. So in video number 1, we took the first step of defining currencies and defining our opportunity set. What we're trying to get to is a point where we define an opportunity set that's essentially tradable, so we can go in there and rely on this opportunity set for volatility, trade idea generation, and potential profit. And we're going to continue now to build out our understanding of the Forex markets and build out our foundation so we can continue on that path towards a systematic process. Now, when we look at fixed versus floating regimes, why would we do this? Well, what we're trying to achieve here is a couple of things. Firstly, when you start understanding the differences between fixed and floating regimes and looking at the history and also the advantages and disadvantages of the two regimes, what you begin to develop is really an understanding of all things macroeconomics. And as mentioned previously, that's what currency trading is all about. We briefly skimmed over this in video number 1, where we stated that a thorough understanding of macroeconomics is required in order to really understand the underpinnings of the international Forex markets. And that's one of the reasons we're going to be building out our foundation and learning about the differences between fixed and floating exchange rates. But the other reason is that it actually helps with our opportunity set as traders in identifying the underpinnings of where volatility may actually lie. And in video number 2, what we actually do, we go through the history of fixed and floating regimes, which is really important to understand. That helps us develop a proper understanding of macroeconomics as we evolve through the video series. But when we look at also the advantages and disadvantages, this kind of gives us an understanding of where opportunities may lie further. And we start to take the next step, which is in identifying a tradable opportunity set within the international Forex markets. So why don't we just go over to the computer screen. We'll go through all of the slides in the presentation and some spreadsheets. There are some resources in the downloads area for you. Okay, so let's go over to the computer screen now, and I'll see you after the video for a recap. Okay, so welcome back to the computer screen. What we're going to look at now is specifically we're going to be looking at fixed and floating exchange rate regimes. Now, the reason why we're doing this is really twofold. Firstly, you'll recall that in video number 1, we specifically looked at the opportunity set, as in the set of opportunities that this asset class, the Forex markets, present to us as traders. And as traders, we seek out volatility, and we deduced very quickly that the standard definitions of the opportunity set are in conflict with our own objective, which is to basically make money with our own money. And due to this conflict, we quickly deduced that our objective of seeking volatility requires currencies to move over any time horizon. And we started grouping currencies based on their regime. And we also grouped currencies based on their commodity dependency, so whether they were concentrated dependency or diverse, so not dependent on one or two commodity prices. So the way in which we've started defining our opportunity set is one of the reasons why we're starting to look at fixed versus floating exchange rate regimes, so we can really understand the underpinnings and get a good foundation of understanding as to what the differences are between these regimes and what the nuances are between these regimes. This will allow us to build out our opportunity set more with confidence and understanding. The other reason we're looking at this is, if you recall, at the beginning of the video series, we did briefly mention that the Professional Forex Trading Masterclass, this video series, is going to be as much a lesson in macroeconomics and international trade as it is about trading and portfolio management. And that's really important, because this is what it all comes down to. This is what currency trading comes down to. It comes down to a thorough understanding of the macroeconomic environment. So as we go through learning about the differences between fixed and floating exchange rates, by default, we're going to be learning how macroeconomics actually really works. And that's going to give us a much greater understanding overall in the currency markets, and really help us even much later on in the video series when we start looking at the systematic processes. So there's a lot of information to get through here. So why don't we maximize the screen and start going through the differences between fixed and floating exchange rates. And first we have to look at the history. Okay, so we're going to look at the history of fixed and floating exchange rates, and really the beginning of modern macroeconomics started during the war, during World War II, in 1944, at the Bretton Woods Conference, where there were 44 nations from around the world that met at Bretton Woods in New Hampshire in the US, and they were there to agree upon a series of new rules for the post-war, post-World War II international monetary system. And there was a major problem in the world. Well, there were a few major problems. The first one was an occurrence of the Great Depression in the 1930s, where basically there were reactive protectionist economic policies brought into force, such as high tariff barriers, competitive currency devaluations, and discriminatory trading blocks brought into force basically in reaction to the Great Depression, which was kind of counterintuitive, because high tariff barriers, for example, is when a country basically puts up tariffs on foreign goods for importers mainly, and that makes foreign goods more expensive relative to domestic goods. And that actually stops or hinders trade, which is counterintuitive to a recession or a depression. What you're trying to do is actually increase the amount of trade and increase economic cooperation and growth. And high tariff barriers are counterintuitive to that. But also competitive currency devaluations, for example, is when a central authority may manipulate the value of their currency lower in order to make their exports cheaper on the international market. And basically these protectionist policies created a problem in the world, in that it created an unstable international environment, and the global economic situation just didn't improve at all. World War II was also a crippling factor. The US and international leaders after World War II basically decided that the only way to deal with these two major issues was further economic cooperation. And this, in turn, would achieve peace and prosperity. So the solution that was put forward was that there was a kind of overriding belief that the system of free trade would promote international prosperity and international peace. And at the Bretton Woods Conference, all of the post-war Allied delegates signed what was called the Final Act, which basically created the International Monetary Fund, the IMF, and the International Bank for Reconstruction and Development. So what was the outcome there? Well, the International Bank for Reconstruction and Development, the IBRD, was given responsibility as a body to provide financial assistance for the reconstruction of the war-ravaged, less developed nations. So given responsibility for the economic development of these countries. The IMF was given a bit more responsibility. The IMF was given responsibility for maintaining a system of fixed exchange rates centered on the US dollar and gold. And they were also responsible for maintaining an orderly international monetary system and the expansion of world trade by providing short-term financial assistance, if it was required, to countries experiencing temporary deficits in their balance of payments. So what do we mean by deficits in balance of payments? Well, if you're a country that imports more than they export, then you're sending more foreign currency abroad than you're receiving currency into your country, and you end up with a deficit in your payments balance. So the idea was that the IMF, if countries saw large shortfalls in payments, so deficits, that the IMF could step in if they wanted to. So what does it all mean? Well, Bretton Woods basically introduced what is known overall in economics as an adjustable pegged foreign exchange rate system. So what happened was the US dollar was pegged to the price of gold, and then in turn, international currencies, so like the Deutschmark, the French franc, the Swiss franc, and the British pound, were then in turn pegged to the US dollar. And the IMF was given authority to intervene when there were imbalances or deficits from or arising from these payments. So with the US dollar being pegged to gold, what this did was actually give the US dollar intrinsic value. So what does that mean? It means the paper currency actually has a value, i.e. the production or supply of new money, new paper. What's supposed to happen is that it's supposed to only increase, so the supply increasing with an increase in the supply of newly mined gold, so at a very slow pace. This basically takes the responsibility of money printing out of the hands of central authorities. So if 1.5% increase in the supply of gold occurs 1 year, then the amount of notes in circulation, the amount of money, can increase by the same amount. And this currency regime is commonly referred to as a gold exchange standard. So this is basically designed to increase international trade. That's the primary objective here of one of these regimes. And it's supposed to do that through stability. So instead of nations, let's say, transporting large quantities of gold around the world to pay for goods between each other, what would happen now is that the US dollar would be anchored to the value of gold and the supply of gold, and all major trading nations would use US dollars in order to pay for those goods. And obviously notes are much more easily transportable. So as a consequence, what happened by default, the US dollar became the world's reserve currency. It became the default currency when paying for goods and services globally between those trading nations. But if you think about what this means, it means that all of the nations require a large amount of US dollar reserves at any one time. Now, the upside to a regime like this is as long as everyone plays by the rules and the terms of trade, then the terms of trade would be predictable. So that would actually increase the amount of trade between member nations, leading to increased prosperity and potential peace amongst the trading partners. But there was a problem. A few years later, so kind of between 1950 and 1969, Japan and West Germany recovered after World War II, and the US's share of world economic output fell from 35% to 27%. So what was happening was that Japan and Germany were recovering structurally and producing goods for the international market that were in competition with US goods. And what happened was that the US increasingly became a net importer of Japanese and German goods and versus the rest of the world, resulting in a negative balance of payments within the United States. So the US ended up with a deficit. Now, during that process, the world did kind of muddle through, but the downside to the whole regime became really apparent when the US had to actually break the rules in order to finance the Vietnam War in the late 60s. And what happened was the US was forced really to print more US dollars to finance the war and print them at a rate that was higher than the rate of newly mined gold. And this made the intrinsic value of the US dollar versus gold increasingly more questionable. And nations such as France and Germany became really nervous and wanted to sell their US dollar reserves in return for US gold. And France themselves called the Bretton Woods system in the 60s America's exorbitant privilege, as the system became asymmetric because the US became seemingly willing to do whatever it pleased with the money supply because they were just printing more and more money. And then in 1965, Charles de Gaulle, the French president at the time, signaled an announced intention to exchange their US dollar reserves, so France's US dollar reserves, for gold at the predetermined, agreed upon official exchange rate. So they would be selling their US dollars in exchange for gold. And the system was really tested later on in the early 70s because West Germany decided that they wanted to leave the Bretton Woods system. And they did this by basically refusing to revalue the Deutschmark, so buying the Deutschmark, knowing that the US had sealed its own fate, and that if they stepped away, then the US dollar would fall relative to the Deutschmark. And they were actually right. Almost immediately, the US dollar fell 7.5% against the Deutschmark. And after this occurred, other nations decided to start stepping away from the peg, as it was now seen that there was artificial stimulus occurring to protect US political interests. So instead of using their US dollar reserves to purchase their own currencies, i.e. to revalue their currencies to defend the peg, foreign governments began to demand redemption of their US dollars for gold. And Switzerland and France both redeemed in 1971. At the time, US unemployment was about 6% and inflation was 6%. And all of this culminated in the Nixon shock on the weekend of August 13th, 1971, where President Nixon, on the advice of Treasury Secretary Connolly, decided to break up the Bretton Woods system. And they broke it up by suspending the convertibility of US dollars into gold. So they basically disallowed foreign countries to convert their US dollars into gold. And this created an overall US dollar crisis, which was then used as a political weapon by Nixon in order to divert the attention of voters away from the realities of these causes, which was essentially America having a protectionist system looking after their own political interests and maintaining their deficit. So Nixon's publicly stated intentions were to break the peg in order to protect its value and to stabilize the currency against speculators. And this was all just political speak because it's counterintuitive. How do you protect the value of your currency if you're allowing it to go down? It doesn't make any sense. So what he means by this, when you watch the speech that Nixon gave, what he means by this is a devaluation of the US dollar. So in order to make US exports less expensive and foreign goods more expensive, to stimulate the demand for domestic goods and create jobs. Essentially what they did by breaking the Bretton Woods system was to start a trade war or currency war. And we're going to watch a video now, which is Nixon's address to the nation, which was made on the Sunday, 15th of August, 1971, before the markets opened. We're going to watch that video now, and I want you to listen to the political speak. This is very important for currency traders to begin to understand that central authorities, when things go wrong, central authorities such as governments and central banks will use political language in order to defend situations that are untenable. So let's watch the video, and we'll come back to the presentation in a second.
The third indispensable element in building the new prosperity is closely related to creating new jobs and holding inflation. We must protect the position of the American dollar as a pillar of monetary stability around the world. In the past 7 years, there's been an average of one international monetary crisis every year. Now, who gains from these crises? Not the working man, not the investor, not the real producers of wealth. The gainers are the international money speculators. Because they thrive on crises, they help to create them. In recent weeks, the speculators have been waging an all-out war on the American dollar. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what is this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar. Now, this action will not win us any friends among the international money traders. But our primary concern is with the American workers and with fair competition around the world. To our friends abroad, including the many responsible members of the international banking community who are dedicated to stability in the flow of trade, I give this assurance. The United States has always been and will continue to be a forward-looking and trustworthy trading partner. In full cooperation with the International Monetary Fund and those who trade with us, we will press for the necessary reforms to set up an urgently needed new international monetary system. Stability and equal treatment is in everybody's best interest. I am determined that the American dollar must never again be a hostage in the hands of international speculators. I'm taking one further step to protect the dollar, to improve our balance of payments, and to increase jobs for Americans. As a temporary measure, I am today imposing an additional tax of 10% on goods imported into the United States. This is a better solution for international trade than direct controls on the amount of imports. This import tax is a temporary action. It isn't directed against any other country. It's an action to make certain that American products will not be at a disadvantage because of unfair exchange rates. When the unfair treatment is ended, the import tax will end as well. As a result of these actions, the product of American labor will be more competitive, and the unfair edge that some of our foreign competition has will be removed. This is a major reason why our trade balance has eroded over the past 15 years.
Okay, so let's go back over to the presentation. And what you saw there actually turned out to be a huge political success for Nixon and the US government. The American public actually thought Nixon was saving them from speculators and a foreign-caused exchange rate or trade crisis. So it's the beggar thy neighbor policy. Blame your foreign trade partners for the problems in your own currency, when actually the problems were stemming from an uncontrollable deficit and the currency being pegged at the wrong value or at a level that couldn't maintain international trade with trading partners sensibly. So it ended up being a political success, but the economic reality was that in the week following, the US dollar fell 2.5% against the Swiss franc, 5% against the pound, and 10% against the yen. Not huge moves, but big enough. And in the year following, the US dollar was actually down 45% against the Japanese yen. And basically by March 1973, all major currencies began to float freely against each other. Since the collapse of the Bretton Woods system, the IMF members have basically been able to choose any form of exchange rate agreement or arrangement that they wish to have, well, except pegging their currency to gold. So currencies now can basically float freely, can be pegged to another currency or basket of currencies, adopt the currency of another country. So countries can actually decide to adopt another country's currency and can participate in a currency bloc or form part of a monetary union, such as the euro, for example. And in 1973, March 73, the US dollar index was founded, and the DXY, the dollar index, is a basket of 6 currencies weighted against the US dollar. The euro, which is 57%, the yen, 13.5%, sterling, 11.9%, Canadian dollar, 9.1%, Swedish krona, 4.2%, and the Swiss franc, 3.6%. That's the modern DXY. So what the DXY looks like today. So the dollar index is a basket of 6 currencies weighted against the US dollar. And today, that is the euro with a 57.6% weighting, the Japanese yen with a 13.6% weighting, the pound with just under 12% weighting, Canadian dollar as a 9% weighting, Swedish krona at 4.2% weighting, and the Swiss franc at 3.6% weighting. And as we already saw in video 1 in our organization sheet, most of the world's currencies are actually now floating exchange rate regimes. And floating regimes are not backed by anything like gold. In fact, the current world monetary system doesn't assign any special role to gold at all. The end of the Bretton Woods system brought an end to a representative money system. And the world, as we know it today, runs what we call a fiat money system. Representative money is most commonly defined as paper or coin that has a claim on a commodity. So, for example, gold or silver. And it can also be called quite generically as a commodity-backed money. Fiat money is currency that essentially derives its value from government regulation or law. The government law basically just states that a particular currency is legal tender of that country or economic zone, and that makes all other forms of paper or coin non-legal tender. Another law is that governments and central banks control the amount of printing of the currency, therefore making it illegal for anyone else except the government to print it. And fiat money basically has no intrinsic value. It's controlled by the government and the central bank. So basically the way a fiat money system works is that society just needs to simply trust the fiat system and have faith in the government and the central bank to manage the economy. So within the economy, managing GDP growth, gross domestic product growth, inflation, so inflation of prices, employment, so jobs, and the balance of payments, so the payments for international trade. And it requires that society has faith in the legal system. So the value of a currency under a floating exchange rate regime is supposed to be determined by the free market forces of demand and supply. However, as we've just seen throughout history, as a result of war, international competitiveness, economic crises, high levels of government debt, throughout history, these situations lead to intervention and mismanagement. And you have to bear this in mind. It's very important for currency markets overall, even in the modern world. So, for example, the Federal Reserve in the US, so the US Central Bank, the ECB, the European Central Bank, the Bank of Japan, so the BOJ, they're not obliged to tie the value of their currencies to anything. They can essentially print as much or as little money as they deem appropriate, and they're in complete control of the money supply. Now, we mentioned earlier we mentioned managed floats. And managed floats are basically floating exchange rate regimes, but with active management from government or central banks, where the authorities make gradual adjustments, and we should have really put that in quotations, make gradual adjustments in the exchange rate in order to manipulate the currency value in relation to others. So freely floating exchange rates are supposed to be left alone, but there is always some sort of management going on from central authorities if currencies that are supposed to freely float create situations in their value that are politically unacceptable. So the idea is that in a managed float, you have a floating regime, but the central authorities are allowed from time to time to intervene and manage or manipulate the value of the currency in the favor of the country that they're in. So this type of intervention is effectively trying to create stabilization in the balance of trade, so in imports and exports. And if the market has no confidence or faith in a currency, liquidity essentially dries up in the currency markets, and this creates volatility. And a freely floating exchange rate can actually fluctuate quite wildly, and it creates a crisis of confidence in trade, and it can become self-fulfilling. And when a government steps in and manipulates the floating exchange rate to the disadvantage of other countries, it's termed either a managed float or a dirty float. So they're kind of breaking their own rules. They're saying we're a freely floating exchange rate, but if the exchange rate becomes too economically or politically unacceptable, we will intervene and manage the value of our currency in our favor. So we've got to get these definitions. We've got to get these definitions under wraps. A fixed regime is one in which the value of a currency is fixed or pegged to something else. So either another currency or, as in the Bretton Woods example, fixed to the value of gold. And in that situation, in the Bretton Woods situation, money can't be printed at a rate that is higher than new gold can be mined. So that stops central banks and governments controlling and printing the money supply and manipulating it in their own favor. That system broke. So it's important to understand the history so we can understand the differences. That system broke, and now all currencies pretty much are freely floating currencies. However, there is a caveat to this. Freely floating currencies frequently are managed through dirty floats, and that's the phrase we use. Freely floating exchange rates are supposed to freely float against other currencies. However, when the value of a country's currency that's supposed to float freely becomes economically or politically unacceptable in terms of competitiveness versus the rest of the world, typically what you will see, and this happens in the modern world all the time, and we're going to touch on this much later in the video series, typically what you will see is central authorities, governments, and central banks intervening in the markets to manipulate the currency in their own favor. Okay, so looking at the Bretton Woods system and the collapse of the Bretton Woods system has given us a decent understanding of the differences between fixed or pegged and floating exchange rate regimes. But what are the advantages and disadvantages of these regimes? Let's look at those. I mean, generally speaking, the advantages of a floating regime are the actual disadvantages of a fixed regime and vice versa. So what we'll do is actually look at the advantages and disadvantages of a floating regime, which will serve the purpose of providing us with the disadvantages and advantages of a fixed regime. So first of all, the main advantage of a floating exchange rate, in theory, is supposed to be an automatic balance of payments adjustment. So demand and supply through market forces, in theory, should always clear at a market equilibrium price. And through exports and imports, equilibrium is supposed to be achieved. So for exporters, for example, when an exchange rate is high or goes too high against all other currencies, exports become relatively more expensive to the same goods produced by other nations, and automatically consumers, so left to the market mechanism, automatically consumers will get to a point and start reducing their demand for the exports of that particular country because they can get the same goods at a lower price from somewhere else. The currency has gone too high, and the importers on the other side are essentially buying the currency first in order to pay for the exporting country's goods. So when the currency goes too high, a country's exports become more expensive. Now let's think of this from the importer's perspective. When an exchange rate is high against all other currencies, imports become cheaper than the same goods produced domestically, and demand for those goods increases. So the exchange rate is supposed to automatically adjust. In this instance, automatically adjust lower. And the domestic currency has to be sold in order to buy the foreign currency to purchase the goods for import. So when you have a high currency value, this makes the same goods that you produce domestically at home, the same goods abroad, they become cheaper. So the exchange rate through exports and imports and through the market mechanism, the exchange rate is supposed to self-adjust. Now, this example with the importers, a good example is raw material imports, for example, as inputs for domestically produced goods. So what happens when, for example, a manufacturer that requires an input from abroad, the manufacturer experiences an increase in the exchange rate. The inputs that they require as raw materials to their produced good domestically become cheaper, and they get from their product higher margins and lower prices. So they get lower import prices, therefore they get a higher margin on their product if they sell it for the same price domestically. And we need to start thinking about the basics of currencies here to underpin this foundation. In order to buy any currency, another currency must be sold first. It happens automatically. And this dynamic theory, it means that a country's balance of payments should always be self-adjusting to some sort of natural equilibrium determined by market forces. So to really understand this, what we need to do is dig a little deeper into how a country's balance of payments works. And really it works as a simple debit and credit system. And this is how a country's balance of payments is made up. And we call it a balance of payments because, given what we just looked at, the payments are actually supposed to balance. And we're going to actually look at this in our systematic process in a lot more detail. But this is how the balance of payments of a modern economy is made up. We basically have a few components that are important. We have the current account balance, the CAB, and the CAB is exports minus imports, and that's for all goods and services, plus the net income from abroad, plus net current transfers. So the balance of payments, one of the main components is the CAB, and the current account balance, the CAB, is made up through net exports or imports, net income from abroad, and net current transfers. The balance of payments is also made up of the capital account, the financial account, and the balancing item. And it's the sum of all these parts. So the balance of payments is the sum of the current account balance, the capital account, the financial account, and the balancing item. Now let's not worry too much about these other items for the moment. So let's not worry too much about the capital account, the financial account, and the balancing item. Let's focus for the moment on the current account balance and the specific component of the current account balance, which is the exports minus imports, X minus I component, so net exports or imports. As I said, we're going to look at this in a lot more detail when we get to our systematic process, which is much further in the video series. And we need to look at goods and services in total. So goods, I mean, we should know what they are. This is all just common sense, really. Goods are just movable and physical in nature. And in order for a good to be a transaction, so recorded under goods, a change of ownership from or to a resident of the local country to a resident of a foreign country has to take place. And movable goods include general merchandise, processing, so goods used for processing, and non-monetary gold. An export is basically marked as a credit, so that's when money comes in. So the money comes into the country and the goods go out. And an import is noted as a debit. So money is going out. Money's going out to pay for the import. So exports are marked as a credit and imports are marked as a debit. The balance of payments follows a debit and credit system, as we discussed. It follows the flow of money. It doesn't follow the flow of the good. So it's the reverse of what you think. So you have to get used to this way of thinking. Get used to the way of thinking of following where the money goes. Services, these are basically intangible items. So things like transportation, business services, tourism, royalties, licensing. These are examples of services. Another service might be if you're an accountant or lawyer and someone pays for your services from overseas. If money's being paid for a service, so if it's being imported from outside, it's recorded as an import, so a debit, in the same way as a good that's being imported is noted as a debit. And if money is received, it is recorded as an export in exactly the same way as goods are. And if debits outweigh credits, so imports outweigh exports, there's going to be a deficit of payments. And vice versa. If credits outweigh debits, there will be a current account balance surplus. So we treat goods and services in the same way because really, regardless of whether it's a good or a service, it's just a debit or a credit in the current account balance. So one of the ways of really understanding this is to look a little deeper into how this works. For example, if the value of imported items to country X equaled $750 billion last year, but the value of exported items from country X to the rest of the world equaled $1 trillion, then the country X would have a positive $250 billion balance of payments, or a $250 billion trade surplus. And a trade surplus is indicative of an economy that's basically called or termed a net creditor to the rest of the world. It basically shows how much a country is saving as opposed to consuming or investing. What this means is that the country is providing goods, services, resources to other economies and is owed money in return for those goods, services, or resources. And by providing these resources abroad, a country with a trade surplus gives other economies the chance to increase their productivity whilst they are running a current account balance deficit. And that's what's referred to in economics, in macroeconomics, as a country financing a deficit of another country. And the way you should think of this is try to think of it in invoicing terms. So if you run a company yourself, you issue invoices and you receive money for those invoices, and you send goods or services when the money is received. If you start to think of things overall in invoicing terms, this makes things a lot easier. We're basically, as a country running a trade surplus, sending invoices to countries that are running deficits and sending resources in return for money. So start thinking of this in invoicing or loaning terms. In the modern world, in modern macroeconomics, Japan remains the largest net creditor nation in the world, and China comes a close second. Now let's think of it the other way around. If the value of imported items to country X equaled $1 trillion, but exported items from country X equaled 750 billion, then the country X would have a negative 250 billion balance of payments, or 250 billion trade deficit. Now this basically reflects an economy that is a net debtor to the rest of the world. It's consuming or investing more than it's saving, and the economy is using resources from other economies to meet its domestic consumption and investment requirements. A trade deficit is less favorable than a trade surplus, of course, but it might not be a bad thing. An economy, for example, might decide that it needs to invest for the future or to receive more investment income in the long term. So the NI and NCT components may actually offset the exports and imports deficit, creating a positive current account balance, or a current account balance deficit might be offset by a positive capital account and financial account. So the current account balance deficit or surplus that can be created by exports minus imports can actually be offset by long-term investment, and that can be from the NI and the NCT components, and it can create an overall current account balance. So it's not necessarily a bad thing, but it's obviously less favorable than a trade surplus. And in the modern world, the US remains the largest net debtor nation at minus 18 trillion deficit, with the UK a close second. So basically, a deficit shows the total public and private debt owed to non-residents, and that's repayable in internationally accepted currencies, goods, services, where the public debt is the money or credit owed by any level of government, and private debt or money or credit owed by private households or private corporations based in the country under consideration. I know this is it gets a little bit complicated, but it's really critical to knowing all this stuff. So I would advise you to go through this video a few times. A surplus shows the total public and private debt owed to the country by non-residents, and that's repayable in domestic currency for goods or services, where the public debt is the money or credit owed by any level of government, and private debt or money or credit owed by private households or private corporations based in overseas countries. Basically, what that's saying is that if you run a deficit, you owe money to other countries in international currencies, and if you run a surplus, you are owed money in your domestic currency. And in theory, the main advantage of a floating rate is that when these things get out of whack, a country's exports minus imports, and keeping all things equal, so if we fix everything else, it's supposed to self-adjust. supposed to self-adjust due to market forces, and a country's current account balance and balance of payments should automatically self-adjust to a natural equilibrium, and optimal resource allocation is supposed to be achieved. Countries that produce get rewarded, and countries that don't produce get punished. And this is supposed to be one of the main advantages of a floating exchange rates system. Therefore, it by default is supposed to be a disadvantage of a fixed exchange rate regime. So in a fixed exchange rate regime, a country is not allowed to tend towards the natural equilibrium or the market clearing rate. And typically what you may see is that large unwanted deficits can occur under fixed exchange rate systems. And that was one of the facets of the Bretton Woods system. So the United States had a fixed US dollar peg to gold, and over a number of years they managed to create a large and unwanted deficit. Okay, so balance of payments self-adjustment is widely seen as one of the advantages of a floating exchange rate regime. Another widely accepted advantage of a floating exchange rate regime is for the flexibility to have a dirty or managed float. What do we mean by that? Well, if you have a floating exchange rate regime, you've essentially not got a fixed or pegged regime. You don't have a rule book or a set of rules that you have to stick to as a government or central bank, i.e. central authority, with your exchange rate regime. So if you have a floating exchange rate, you actually have the flexibility to intervene whenever you want and not stick to a certain set of guidelines or rules as set out by the fixed regime. So a floating exchange rate is sometimes called a flexible exchange rate regime, whereby the government or central bank has that flexibility to intervene if necessary. And they would do that really only if there are temporary shocks to the exchange rate regime. So, for example, exogenous shocks, so shocks that are outside the central authority's control. And these shocks can be both upwards and downwards in the exchange rate. So let's look at a couple of theoretical examples here to get a better understanding of what we mean. So if, for example, you're an importer, so you're a country that's a net importer of goods, so you're running a deficit, a sharp increase in your exchange rate due to an exogenous shock, so a shock that's outside of your control, a sharp increase in the exchange rate can make imports cheaper. And that can cause a deficit to actually get out of control. What if you're an importer who's a net importer running a deficit and there's a sharp decrease in the exchange rate? Well, this makes imports expensive and can cause growth to slow, because you can end up in a situation where if the structure of your industry in your country imports the goods necessary as inputs to your manufacturing process, if those imports become more expensive, then this can have a negative effect on your industry, because it can decrease margins now that the import prices are more expensive. So with an importer, both an upwards movement and a downwards movement in your exchange rate can have both positive and negative impacts. As an exporter, so let's say, for example, you're a country who's a net exporter of goods and you're running a surplus, a sharp increase in the exchange rate due to some exogenous shock that's out of anybody's control. A sharp increase in the exchange rate makes your exports more expensive and can cause your surplus to go lower. And this can create a situation where you get deflation in the prices of your exported goods. Obviously, that's not good for exporters. If you're an exporter running a surplus and you get a decrease in the exchange rate, this can make exports cheaper and can cause much higher levels of growth above your production capacity as a nation. And this can cause inflation in your exported goods. And inflation can be a bad thing as well. So there could be shocks to your system created by exogenous factors if you're a floating exchange rate regime. And it all depends on the situation that you as a country are in. But essentially, because these shocks can occur, the flexibility for central authorities, the ability for central authorities to go into the foreign exchange market whenever they want, can be advantageous because they can readjust the currency and they don't have to adhere to a strict and stringent rulebook. So floating regimes are sometimes referred to as flexible regimes because it does give the central authorities flexibility. In cases of extreme appreciation or depreciation in the exchange rate, a government or central bank will be able to intervene and stabilize. The word stabilization is generally favored by politicians and central bankers as the rhetoric rather than the words volatility and speculation. And floating currencies in the modern world are frequently manipulated by governments and central banks. And they should really not be technically known as floating regimes. What they should really be known as are managed float or dirty float regimes. And there's an ongoing joke in the financial markets, and this is a nice example. So this sticks in your mind. There's an ongoing joke that Janet Yellen is a dirty floater. Discuss, because the Federal Reserve in the United States frequently intervene to manipulate the value of the dollar upwards and downwards. The monetary levers for intervention are basically buying and selling foreign and domestic currency, and the classic monetary levers of interest rates and money supply. The reason why this is an advantage is because these levers can be used to enable depreciation and appreciation of an exchange rate if it gets out of control. So it becomes a managed float. So out of control due to exogenous factors. So central banks and governments react accordingly to the strength or overstrength or weakness or over weakness of their currency by using these monetary levers. With a fixed exchange rate system, there's literally no flexibility to do anything. So this can be a good thing, and it can also be a bad thing. And it can be a bad thing because it just gives license to central authorities to do whatever they want, whenever they want, potentially. So it can be a good and a bad thing. The other thing that floating exchange rate regimes have in terms of potential advantages is that it gives the central authorities a monetary policy focus. So it allows government and monetary authorities to concentrate on other important economic factors. So, for example, under a fixed exchange rate regime, monetary policy is committed to the single goal of maintaining the exchange rate at the announced level. But the exchange rate is only one of many macro variables that monetary policy can influence. A floating exchange rate regime leaves the economic participants free to concentrate on what matters, so competitiveness. If the exchange rate self-adjusts, then it's self-regulating. So governments, the public sector, and companies in the private sector can concentrate on investment in infrastructure, so increasing capacity, increasing production capability, increasing production itself, producing higher quality goods at better prices, and job creation and price stabilization. So having a stable inflation environment. So instead of governments or central banks intervening in the currency markets, they can forget about it and just use structural programs. So incentives like regulation and taxes, interest rates and money supply to control competitiveness. Because in a floating system, in theory, what's supposed to happen is that the price mechanism is supposed to self-adjust. Balance of payments are supposed to self-adjust. And basically what happens is if governments and central banks leave the exchange rate to freely float and don't intervene in any way, then they will just be concentrating on this internal policy. So structural incentives and using interest rates and the money supply to create conditions for the private sector to grow and to increase competition. Now, if the government or central bank does a bad job of this, then the exchange rate just simply has to devalue. So essentially, the global marketplace just holds them to account. The market will punish bad government or central bank behavior, so mistakes, and reward good behavior. So in a society that operates like this, democratically speaking, voters are essentially outsourcing the political scorecard to the international marketplace. And outsourcing the political scorecard to the market, essentially, can be very advantageous because it means that the market will hold the central authorities to account. If they do a good job, they get rewarded by the market. If they do a bad job, they get punished by the market. The next advantage is basically one in terms of commitment. So when a government or central bank signs up to a fixed exchange rate system, what's happening is they're making a commitment to their trading partners or political allies that they're, no matter what, going to hold their currency to a peg level versus another currency or a basket of currencies, or even to the value of a commodity, so like the Bretton Woods system. Once that commitment is actually made, there's no turning back. And this could potentially cause negative economic consequences for a country or economic zone, and could cause major political problems. Because what you've essentially done when you sign up for a fixed exchange rate system is that you've given up your domestic sovereignty. You've given up the ability to control the value of your own currency. And once a country gives up the right for market forces to determine their exchange rate or the right to intervene to stabilize their currency, they give up this sovereignty to the peg itself and potentially to their trading partners. Also, there's always the issue of setting the correct rate. So what is the correct rate? Who actually decides that? And what if the rate is wrong and cripples your country economically? All these questions cannot be answered until you give up your sovereignty. And the Eurozone is a classic case of this. So when you look at the PIGS countries, the term we use is PIGS for Portugal, Italy, Ireland, Greece, and Spain. It's a classic example because they have differing output to the rest of the region, but they have a fixed common currency across the entire Eurozone. The problem is they have to stick within the currency regime, and they can't depreciate to make their goods or services competitive on the international market. They're locked in. They've given up their sovereignty, and one argument is that they joined the euro at a rate that is unsustainable for the countries themselves. So it might be sustainable for countries like Germany, but it's not sustainable for countries like Portugal, Italy, Ireland, Greece, and Spain. So a floating rate, one of the advantages is that you don't have this long-term commitment. You still have the right to intervene, and you allow your currency to freely float. If there's a problem, then the central authorities have the flexibility, which was the previous advantage, the flexibility to intervene if necessary. So that pretty much sums up the overall advantages of floating exchange rate regimes. Now, what we're going to move on to are the disadvantages of floating exchange rate regimes. Now, as we mentioned earlier, the advantages of floating exchange rate regimes are essentially the disadvantages of fixed regimes. Therefore, the disadvantages of floating regimes are the advantages, or serve as the advantages for fixed regimes. So now we're going to look at basically the disadvantages of floating / the advantages for fixed. And the main advantage and the main argued advantage for fixed exchange rate regimes is the elimination of volatility for importers and exporters in the terms of trade. So it's argued that importers and exporters have more certainty under a fixed regime. So think about this in terms of an importer first. An importer, for example, that has fixed costs and variable costs, so fixed capital investment and raw material costs that are variable and move on future production and can be exposed to an exchange rate. So an importer that, for example, brings in an input from another country into their manufacturing process. It's argued that under a fixed regime, these importers, their investments are not subject to movements in the exchange rates. Therefore, it's argued that this encourages more capital investment and trade as margins remain stable. So margins are very predictable. Now think of this in terms of exporters as well. Exporters under a fixed regime can sell as much product as they want at a fixed rate. So they know that they've got a certain level of demand at a particular fixed price. And this means they can forecast revenues and profits with a lot more certainty. And it's argued that this encourages more investment and trade. But there is also a downside to this argument because it can actually hinder competitiveness. Now, when you get certainty in both of these cases for importers and exporters, it can decrease competition in the industrial sectors or the service sectors that they are actually in. So, for example, let's say you're an importer and you have fixed capital costs at a fixed exchange rate and your raw material costs are fixed, and you make a fixed margin and everything is very sustainable and very predictable because the exchange rate is fixed. Well, that allows you as an importer to scale your business to unprecedented levels and to do that without any competition. As an exporter, because you have certainty over revenue and profit, and you can sell a fixed level of goods at a particular fixed price because the exchange rate is very stable, you can forecast your revenues and profits. Therefore, you can scale the business to any level you want. You just need the investment to go bigger. And what this can actually create is monopolistic situations, so it can hinder competitiveness. So just bear that one in mind. However, this argument that importers and exporters get more certainty by default becomes a disadvantage to free float regimes, because it's argued that the volatility in exchange rates causes speculation. What you've also got to remember is that if there is volatility in exports, in a free floating regime, in exports and imports, in a free floating regime, both importers and exporters can actually go into the financial markets and hedge forward their currency exposure. We're going to look at this in a bit more detail later. So there's obviously arguments for and against, and you can be in either camp or both camps. You just need to understand the arguments, because from a trader's perspective, when we see these things occurring in the market, we just need to understand how these mechanisms work. One thing we touched on there when we looked at potential volatility for importers and exporters was the volatility and the potential for volatility to encourage speculation. But there is an argument as well to say that fixed regimes can also encourage speculation, because they encourage, in particular, speculation of both government and central bank foreign currency reserves. So basically, when a government or central bank intervenes in a fixed system, in order for them to buy their own currency, they need foreign currency reserves. If you remember earlier, we talked about the mechanism by which a currency is bought. Well, a currency can't be bought without first selling another one. That's how the international foreign exchange markets work. You automatically sell one currency when you buy another. You have to swap them. And governments and central banks must have foreign currency reserves in order for them to buy their own currency, in order to support it. And this, for example, could be what we call the lower bound of a peg or fixed system. A fixed system usually has a lower and an upper bound, where basically the central authorities, if the currency value goes below a certain level or touches a certain level, the central authority will use foreign currency reserves in order to buy their own currency in the open market in order to support the currency. If the currency value goes to the upper bound of a peg or fixed system, they will use their own currency to sell their own currency in the foreign exchange markets, and by doing so will move the currency lower, or that's what the intention is, and receive foreign currency reserves in return. But there is a little problem with this, because a fixed system is known, and the financial markets know that if a fixed system is in place, then the government or central bank must be holding a certain amount of foreign currency reserves in order to support their currency. And this creates speculation in itself as to how much foreign currencies there are, how much foreign currency reserves there are sitting at the central bank or the government is holding. And what can happen is what happened, for example, with the ERM crisis in 1992, where the British pound got to its lower bound against the Deutschmark, in the exchange rate mechanism. And George Soros, pretty much figured out how much foreign currency reserves the British government had. And the market sold more than the amount of foreign currency reserves that the British government had to the British government, sold the pound to the British government, and the British government ran out of foreign currency reserves. And that created a situation where the pound collapsed because the central bank couldn't support their currency. So this idea of this argument of volatility and speculation not occurring in a fixed regime does have its downsides, because history has actually proven that even in a fixed regime, speculation occurs. So speculation is also a feature of fixed exchange rate regimes. So it's debatable if it really is a disadvantage of a floating regime. So just something to think about there. Okay, so the next disadvantage of a floating exchange rate regime that we're going to look at, or potential disadvantage, we actually looked at a bit earlier as an example of an advantage of floating exchange rate regimes. The flexibility for dirty or managed floating. So you may remember this slide from earlier. Flexibility, I think we briefly skimmed over it. Flexibility to be a dirty or managed floating regime. That flexibility can also be a disadvantage, because the government or central bank, so central authorities, in a flexible situation also have an open mandate to do whatever they see fit with monetary policy levers. So they can buy and sell foreign and domestic currency reserves, use interest rates and money supply in order to manipulate the value of the exchange rate. And what does this mean? It means that the electorate of a democratic country, democratic system, may actually be giving up sovereignty of their currency to an unelected body. So in a dirty or managed float mandate that's enforced, it could be enforced by a non-publicly elected body, such as a central bank committee, and this could actually be a threat to democracy. This is all part of the wider question, which is who is really to decide what is best for a country's currency and the people of the country. Is that an elected representative or the head of an appointed committee or an elected committee of experts? And a good example of this could be in the United States right now. So the Fed balance sheet has grown since 2009 from $1 trillion to $4 trillion in 2014. Now we're going to look at the details of this much later on in the video series, so don't worry too much about the knowledge and understanding of exactly what's going on here as yet. It will all be explained later. But the Fed's balance sheet growing from 2009 from 1 trillion to 4 trillion in 2014 due to quantitative easing, as in increasing the money supply and shifting government debt from the private sector to the central bank balance sheet, because quantitative easing is the central bank essentially purchasing government bonds, and those bonds sit as assets on the Federal Reserve's balance sheet. And this can be a good example of how sovereignty is lost in a country, because now there's a conspiracy theory that says the Federal Reserve has its own agenda. The Federal Reserve's agenda is to control the US government by owning large portions of US government debt. And if you control the US government and their spending and taxation, you control America. Now, obviously, that's a conspiracy theory. I'm not massively into conspiracy theories myself, but you can see the argument. The argument is that a non-directly elected committee, a non-directly elected committee by the electorate, is essentially setting their own agenda. This could be a situation in which the spending of the federal government in the United States is determined in the future by what the Fed will or will not allow them to do, because they are one of the owners, or a large portion of US government debt. So this whole idea of floating exchange rate regimes providing an advantage of flexibility for central authorities to intervene, this could also potentially be a huge disadvantage in terms of sovereignty in overall society. Okay, so plenty to think about there in terms of the advantages and disadvantages of floating exchange rate regimes, and therefore inferring the disadvantages and advantages of fixed exchange rate regimes. What we're going to do now is continue to build out our foundation and link all of this together. So you'll recall in video 1, we were looking at opportunity set. And so far in video 2, we've looked at fixed and floating regimes, the differences between them, and the advantages and disadvantages of both regimes. And our understanding of these regimes now is going to give us the ability to move on and look further into the potential opportunities and volatility in the Forex market. What we've also done by doing this is what we mentioned earlier, which was to start to really build an understanding and foundation of all things macroeconomics, all things macro. And this is going to continue to be a theme throughout the video series. As we referred to earlier, the Forex Trading Masterclass is as much a lesson in macroeconomics and international trade as it is for learning how to trade the currency markets outright or as part of a portfolio. So we'll continue to build that out and build our macroeconomic knowledge. But we can use this knowledge now for our objective of defining an opportunity set. And we're going to continue to drill further in defining what our opportunities may be. In fixed regimes, there's obviously very little volatility unless the fixed regime breaks. And that means the central authorities basically decide not to support their currency anymore, or decide in some way to leave the regime. But what we've got to do in order to continue to build out our opportunity set is we've got to understand further how the pegs actually work in practice. And this is also by default going to increase our macroeconomic knowledge. So if we ever see these things in the future where a fixed regime or peg breaks away, then we know potentially that volatility is going to occur, and we know how to deal with the situation. So we've got to understand how the pegs in the real world actually work. And you'll remember earlier from the Forex markets organized sheet that we split up our pegged regimes into X commodity and commodity pegged situations. In the commodity section, we had most or all of the GCC countries, and we had the Chinese yuan. in the X commodity pegged area, we had the Danish kroner, the Hong Kong dollar, and the Singapore dollar. And what we've done for you in the download section of video number 2, there is another spreadsheet entitled Forex Universe Tradable Complex. And in the first couple of sheets within the spreadsheet file, you're going to see tables which relate to pegged regimes. So let's go in there and open this up now. So what we have here is X commodity pegged and commodity pegged, and inside the next sheet we have them all laid out as X commodity pegged and commodity pegged, but with what we call the upper and lower bounds of the fixed or pegged system. And on the right hand side here in column I, we also have some qualitative notes on how the pegs actually work. Now, we're not going to go through every single one of them. We don't really have time for that in a video series. But what you should do is, in your own time, go through every single one of these and really learn about them, because in the future, these pegs may change. And you should always keep this in the background. So overall, what we're going to do is basically make the statement that in fixed and pegged regimes, day to day, week to week, month to month, or over any decent time horizon, the value of the peg or the value of the exchange rate is not going to change materially. We're not going to get significant volatility out of them regularly, and therefore we can't make money consistently as traders out of these currencies. So we're going to have to disregard the vast majority, if not all, of our pegged currencies. But we're not going to be lazy and just completely ignore them. We're still going to learn about them. So in your own time, please learn about these and go through all of the qualitative statements here in column I and learn about these pegs and what they actually mean. You'll learn some different definitions, for example, the Chinese yuan being pegged to a crawling band being pegged to the US dollar, and essentially it being a hybrid situation where it's a crawling band / managed float, and there's a daily fixing at 9:15 in the morning Beijing time, and the bands and bandwidth of the pegs are managed every day. So go through all of these, learn about them, and in your own time you can begin to really understand how they work. We're just going to go back to the presentation now, and what we're going to try and move on to is where our real opportunities will exist. And our real opportunities exist in the floating situations, the floating regimes. So our opportunities as traders in the currency markets are really dictated by volatility, and the volatility is primarily in the floating regime currencies. And what we've done is we've taken the same approach as the fixed or pegged. We've, in the Forex Universe Tradable Complex spreadsheet file, got a couple of sheets in there that break down everything for you by X commodity floating and also by commodity floating. So let's go into the sheet now and we can show you how this is broken down. So we have all our floating currencies here, whether it's X commodity or commodity, and we have our two tabs here, X commodity and commodity floating. And if we go into the X commodity floating, you can see that we define by developed float, EMEA float, and Asian float. So there are no LATAM floats for X commodity. And in commodity float, we've defined by developed, EMEA, Asian, and LATAM. So now we've drilled down a further level. We've drilled down another level and said, okay, we understand the fixed Forex regimes, but we're going to understand them but not trade them over timeframes that as traders we need to trade over in order to make consistent profit. The fixed regimes are not going to make us money over classic time horizons like 1 day, 1 week, 1 month, 3 months, maybe even a year, because the fixed regimes are trading in extremely tight ranges, and we don't want to be sitting here as traders for months or years on end just watching currencies doing nothing and hoping for something to happen. But we need to understand them, because when something does happen, we will be able to trade them. So let's not 100% forget them. Let's just put them to one side. And what we're trying to achieve here is to get a tradable opportunity set that allows us to consistently make money from the Forex markets. And we're trying to define this opportunity set not just in terms of consistent volatility and consistent opportunities. We're also trying to define this opportunity set in terms of what is tradable. So what is tradable on general trading platforms, and get to a point where we have an opportunity set that's tradable for the retail environment. It's going to be obviously very difficult if you're a retail trader to take positions in the Egyptian pound. So we then even move on to the next level, which is to say, okay, we've defined our opportunity set in terms of volatility and opportunities, but now we need to break down even further what we can and can't trade. And what's tradable is what you see here in front of you, defined as X commodity pegged, X commodity floating, and commodity floating. So we have included some X commodity pegged currencies here because they are actually tradable on most decent retail brokerage trading platforms, whether that's as CFD, so contract for difference, in the United Kingdom, Europe, and Asia Pacific, or in the futures market in the US and Canada. And we've got this list for you here in the Forex Universe Tradable Complex spreadsheet in that file. And we have all the tradable instruments here. What we've also got is what's generally not tradable. So we've split that up into the X commodity floating currencies, the commodity floating, and the commodity pegged currencies. These are a universe that basically are generally not tradable on retail trading platforms. So again, download the spreadsheet, go through the process yourself, understand how we've got to this point, and you'll be able to do that in your own time. We have the tradable complex here. What we have here is the non-tradable complex, so screenshots of the spreadsheet that you have access to in the downloads area. And what this leaves us with is a situation where we can now define in an even more specific way. So we can start to define as X commodity floating majors. Now what that means is that the currency is a floating regime It has diversity in its exports, so it's not dependent on one or two commodity prices. And it's considered a major currency by retail brokers. We have here the ex-commodity floating miners. So these are currencies that are available on a lot of retail brokerage trading platforms. But they're defined in our set as floating currencies, floating regime currencies that don't have significant commodity exposure and diversity in their exports, but they're considered by the retail brokerage platforms as the miners, so minor currencies. We also then split up by commodity float and commodity float majors and commodity float minors. So the commodity float majors, so majors as considered by retail brokers that are floating regimes, and the value of the currency depends very heavily on the prices of one or two international commodities. And then we have miners that are considered miners by retail brokerage platforms that are also dependent heavily on one or two commodities. So what you see in this table here is a big extension of what you might see on typical media outlets, where you get a lot of the noise perpetuated by participants with conflict of interest. We've created the big extension. We've increased our universe by defining correctly how currencies should be defined, or any asset should be defined as a trader, defined by volatility, opportunity, risk, and availability. We also have, right on the corner here, are ex-commodity pegged situations. So these currencies are generally available on retail brokerage platforms, but really we're interested in where the volatility is. We've included them just in case pegs may change, but we're really interested in what's going on over here. We had earlier the dollar majors and the major crosses as a table. That's the generally accepted table for media outlets and participants with conflict of interest in the currency markets. What we've done is now extended this, and what we've got here is a breakdown of the classifications that we've applied. So we've got ex-commodity float majors, 5 in total. Ex-commodity float minors, 4 in total. Commodity float majors, 3 in total. Commodity float minors, 8 in total. Ex-commodity pegged, 3 in total. Total opportunities equal 23, but debatable because of the commodity pegged situation. Total opportunities 23, gross net 20, and all of these currencies, in theory, can all be traded against each other. So the maximum opportunity set we've got, if we have a platform where we can trade all of these currencies, well, they can all be traded against each other, not just against the US dollar, and not just the majors traded against each other, but across the whole spectrum. So in theory, the Norwegian krona doesn't have to be just traded against the US dollar. The Norwegian krona can also be traded against the Aussie dollar. So we've also applied some qualitative analysis here, in that we're looking at potential volatility. And generally speaking, what you're going to find is that the more liquid the currency pair, the less likely volatility will occur. Because with more liquid currencies, there's more participants at any one price buying and selling. And this reduces volatility overall. It's kind of the opposite to the way retail traders think. A lot of retail traders think that it's good to go and trade the liquid currencies because they have less risk. But risk is subjective, especially if you're leveraging 100 times in that asset to try and capture volatility that doesn't really exist. So generally speaking, the more liquid the currency pair, the less likely volatility is going to occur. With more illiquid currencies, we're going to pay a wider spread and have a higher margin requirement. However, we can use less exposure to obtain higher volatility and returns. With liquid crosses, retail traders are generally forced into over-leveraging in an attempt to magnify the volatility over short time horizons. And we're talking about volatility here that might not necessarily exist. And what you're going to find in trading currencies is that the big profits can be made in currencies that you wouldn't normally expect. The big profits are the big opportunities. They come obviously with risk, but the risk can be controlled, whereas the volatility can't. The volatility just is the volatility of the asset, and that gives you either the opportunity or not to take positions and make money. Big profits in trading liquid currencies can be made, especially if you're massively over leveraging. But this comes with a huge risk of hefty losses. And this is one of the main reasons why the vast majority, as in over 90% of retail traders, lose all of their money or very close to all of their money in a very short space of time. It's because they're trying to capture volatility that doesn't exist with large amounts of leverage. Now, I want you to think about this on the flip side. Volatility creates opportunities for traders. Now, if we select a very liquid, very popular currency pair to trade, and we want to trade this on a very short time frame, and there's very little volatility in the popular currency pair, that means there's less opportunity for the trader, but it also means there's less risk for the broker. And we're going to come on to this later. One of the main reasons why brokers want everybody to trade these currency pairs, the majors and the major crosses, so the dollar majors and the major crosses against each other, is because simply they're just the most liquid. And that means less risk for the broker. We'll come on to that later. But essentially, we've got a maximum opportunity set now of 506 currency pairs across this entire spectrum here. You're going to find this sheet over here. And this is the Tradable Crosses Opportunity Ranked Excel spreadsheet. We'll be looking at this later as well, when we look at the examples that we're going to use in further video modules. Let's do a recap. There's been obviously a lot of information in this video to take in. We do like to throw people in at the deep end. Immersion is always good for learning. What have we learned so far? Let's recap. So the objective, let's lay it out again, was to provide retail Forex traders with a systematic approach to predicting future currency pair moves in the same way as professional traders and hedge fund managers. So retail Forex traders can implement the same approach. And what have we done to start to do this? Well, we started to organize the Forex markets into 4 main groups. And this is how professional traders do it. We look for money-making opportunities. And we got to the point where we defined our currencies as X commodity floating, X commodity pegged, commodity floating, and commodity pegged. And that's because as professional traders, we're seeking the volatility and the best currency pairs to make money from. But we've gone one step better now. We've started to segment the currency pairs into more distinct definitions. We've now taken the next step, which is to define these currencies as actually tradable. And we've got to the point where we have 4 new definitions as ex-commodity floating majors and minors, and commodity floating majors and minors. And we've also got a situation where we're keeping some of the pegged currencies on our list because they're available on retail brokerage platforms. So by segmenting this way, we've taken the first step to identifying our profitable trading universe. So what we mean by that is being consistently profitable over the typical trading time horizons. And understanding the differences, as we have done in this video, between pegged or fixed exchange rate regimes and floating or managed dirty float regimes, we've ranked our opportunities in order of a tradable universe, and we've also ranked them potentially in a way that creates a volatile to least volatile ranking in the set. Later, what we're actually going to do is really get our hands dirty, and you're going to be doing this with Christopher Quill. Really get our hands dirty in actually calculating the volatility of these currency pairs with statistical analysis, and look much more closely at how commodities themselves impact currency pairs. So we can dig a lot more deeper and get a real deep understanding of assessing volatility and trading opportunities. But first, however, we're going to continue to build out our foundation, continue to build out our opportunity set, continue to understand the underpinnings of the Forex market, and continue on our journey of becoming much more knowledgeable in macroeconomics. So let's go back to the trading desk for a quick recap, and we'll move on to video number 3. Okay, so welcome back to the trading desk. What we looked at there were the differences really between fixed and floating regimes. And by doing so, what we did was pick up a lot of macroeconomic information. So we started at Bretton Woods and we looked at how the macro environment has evolved over the last 60, 70 years. And as we picked up this macro knowledge, what we focused on really were importers and exporters, and how importers and exporters are affected by the exchange rate, and also how the exchange rate is affected through deficits and surpluses in the balance of payments. And that's one of the major drivers of exchange rates. And we're going to realize as we go through the video series later that there's a lot of primary concerns in economies and societies, such as GDP growth, employment, so people's jobs, and inflation. And that's why governments and central banks get involved. And we picked up a lot on that as well. So importers and exporters, deficits, surpluses, and also central banks and governments, what we're starting to realize is we're starting to realize that these participants in the Forex markets are very, very important because they are drivers of the exchange rate. So we've been on this little journey of learning and understanding the differences between fixed and floating exchange rates, and picked up a lot of macroeconomics in terms of macro knowledge along the way. But what we also did as we went through the presentation there, the differences between fixed and floating exchange rates actually start to begin to give us new definitions for our opportunity set. And again, we're going back to this point where we have to, as professional traders, focus solely on volatility and look at this asset class with objectivity. So the definitions that we now have come to in terms of our tradable set are X commodity floating, and X commodity pegged. And we overlaid this with currency pairs that are generally available or tradable on brokerage platforms, so publicly available or available to retail traders. And we started to express these tradable pairs in those 5 genres and overlaid that as well with a ranking system of volatility. So we've not only picked up the advantages and disadvantages and the differences between fixed and floating regimes along with the history, we've also picked up knowledge along the way in how we can actually rank our opportunity set. And we do this obviously by volatility, and volatility is inherently linked to the regime of the currency. And what we learned is that floating regimes can often be, in reality, dirty or managed regimes. So we've been on this little journey of learning the history, and we've picked up a lot of knowledge along the way, and we've got enough information to continue to build out our foundation now to evolve into a systematic process, because the foundation is being built. And if we continue to build this out, the systematic process becomes a lot easier to understand and actually implement, because we understand the market dynamics that we're operating in. So what we're going to do now is go over to video number 3, and I'll see you at the trading desk for a rundown through Forex market infrastructure.
Created with free version for non-commercial use.